Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited to be joined today by Sam Russ. Sam, welcome to the show.
Thanks for having me, Whitney. Good to be here.
Yes. Well, Sam, before we dive into the details of the Diamond, 54 units, mixed use in Parkville, Missouri, tell us a little bit about yourself, your background, and how you got into the multifamily space.
Yeah, thanks, Whitney. So born in Colorado, lived all over the Mountain West. Grew up on a family farm where my parents really cared about educating their children and giving them opportunity to work hard. So family farm provides a lot of that. Ended up with my wife and a couple of kids in Denver back in 2014. And while we were there, started listening to different podcasts and trying to figure out a way that I could take some capital that I had and grow that through investments that I could control. Came across the idea of syndication, made a lot of sense. Syndicated my first deal in 2018 down in Colorado Springs. And then shortly after met Whitney Sewell, who some of your audience may be familiar with. We partnered in 2019 at LifeBridge Capital, and now LifeBridge Capital is about 1,500 units. Currently, we're the direct operator across a mix of Colorado, Idaho, and then Missouri are the three states that we focus on currently.
Well, awesome. Right in my hometown or home state of Colorado. I love it. Well, let's dive in. Okay, we got the Diamond, 54 units, mixed use. So there is multifamily to this in Parkville, Missouri. When did you close on the property and what was the purchase price?
So we bought this property in November 2024. So just about 8 weeks ago as we're recording this for $13 million.
All right. How did you find the property? Like, did you find it through a broker, dealer, was it off market? Like, how did you find it?
Yeah, so this property came to us from a developer. We kind of have a two-prong acquisition strategy or even like business plan that we run here at LifeBridge Capital. Some are value add. Value add is hard to complete at this point in the cycle with debt where it is. But we also have had a lot of success over the years building up relationships with developers in target markets and buying directly from them. And this is a great example. We actually bought another piece of this development 2 years ago from this same developer through a variety of connections. And so we have been aware of the Diamond for 18 months or so. We wanted to wait to purchase it until it was stable, both on the multifamily side and the retail side. And it was marketed, but we were the right buyer because we own another property within a couple hundred yards of this facility. 54 units is not large in multifamily. And so we have better economics of scale compared to anybody else who was going to come in and try to manage this. So though it was marketed, we were engaged for a year and a half in conversations with the developer and ultimately were able to strike a good price.
And so, before we move on to like how you structure the offer and due diligence, I do want to kind of pick your brain a little bit here. You mentioned that you were in conversations for 18 months, and we talk a lot about on the show that relationships and is core to, scaling your real estate business. How did you stay top of mind for those 18 months?
That's a really good question. Through a variety of means. The developer is a guy who's kind of mid-career. He's been developing for 25 years in the Kansas City market. He's fairly well known there. This is a part of a 360-acre development that he's spearheaded over the last 5 years. And so part of it was us just buying a couple other pieces of property from him. And then as I would make trips out there, I live in Idaho. This property's in Kansas City, but I would make a point to sit down for lunch or dinner with Brian and just enjoy, getting to know him, showing interest in some of the things that he's doing. He's a very interesting guy. And then also he's looking to sell. One of the interesting things about developers is even though for those of us who invest in stable real estate, we see the opportunities, whether it's value add or just long-term holds. Developers think very, very differently, and they're always on the lookout for people who can help them flip properties quickly that they have constructed so they can go buy that next piece of ground. They're very visionary. They're very development oriented. And that just leads to a different mindset. And so we traded LOIs for a good part of that 18 months, going back and forth and then letting the market kind of speak and bring some reality to bear on the situation as well.
Well, okay, we got a LOI on the table. How did you structure the deal for this property?
So ultimately, we wanted to make sure that we bought this deal stabilized. The developer had a value that he wanted on this deal. And when he originally pitched it to us, it was vacant, completely vacant. It had just been completed. And we just didn't want to take on that level of risk without being compensated for it. The more risk, we're fine to take more risk. We just want to be paid to take that risk. And one of the big dangers in real estate is that you take on risk that you either didn't quantify on the front side, or that you weren't paid to take. And so in that sense, there was a pretty big delta originally between what he wanted for the property and what we were willing to pay. But we stayed in touch and really just kept it pretty simple. We're like, we want the multifamily piece to be 90% occupied or above. And we want the retail to be completely leased. We had bought some other retail from him, and are in the process of leasing that up ourselves. But ultimately, he was very focused on purchase price. And when you're solving for that, then that means that we need the deal to be as de-risked as possible.
Mm. All right. So how long did you, between submitting the original LOI, did you actually get under contract? And then how did you actually structure that contract? Is it a standard 30-day due diligence period, 30-day closing, extensions?
Yeah, so we originally submitted our first LOI in January of 24. After 6 months of going back and forth, and then eventually went under contract in, I think it was late July. And so our contract was a 75-day contract with a 30-day extension. We ended up closing within the 75-day window. Fairly standard contract. The one maybe little wrinkle that we added was to ensure that there was some money tied to the property staying 90% occupied or above. We wanted to make sure that operations didn't slip during that time. And so we included that clause in there. And then there was a couple of small wrinkles around the retail piece. We had two separate contracts because though it's one building, they're separate condoed out buildings actually, or just deeds. There's two deeds. So we had two PSAs and we had to do a little bit of special negotiating around one of the leases on the retail side that hadn't yet taken possession. So those were kind of the two wrinkles that we were dealing with on our side.
And what kind of earnest money did you put down on this deal?
We put down around 1% of the purchase price. And then if we had needed to put another or ask for that other 30-day extension, if we exercise that right, it would be another 0.5%. So we put of that 1%, we put half down up front within 3 days of signing the contract, and then the other half after a 30-day due diligence period.
Well, let's talk about the due diligence. I mean, this is a ground up development, new build. How did due diligence go on this project?
Due diligence was really smooth. This developer builds good assets. It's always nice when it's new. It's a lot easier. You know where the clean outs are, that you have the construction drawings. Everything it's just much simpler. But we went through our typical process. We walked all the units with our property management team, and then we hired a third party inspector along with another property condition assessor that was hired by our lender. So we ended up with the lender's report, our third party due diligence report, and then our report from our property management company and our acquisition team that walked all the units.
Mhm. And were you present for the inspection?
I actually was not present for this inspection. Our chief acquisitions officer was out there with a couple other folks from our organization. I had walked the property prior to us putting it under contract. But due to schedules and everything else, I personally wasn't able to make it out there for this one.
So I'm always curious, how does physical due diligence on multifamily different from, the retail side of things on these mixed use properties?
There's a lot of the same things when it comes to major systems. On a newer building, it's just easier because the furnaces are new, the hot water heaters are new. If that weren't the case, then you'd want to make sure that you have a really good handle on your heating and cooling elements of the building. There's a lot more moving parts and pieces usually in a multifamily space than retail. There's just more systems to inspect. So you have to get a little bit more granular. This particular building has 15,000 square foot of retail that's leased, about 80% of that to a daycare that's under construction currently, with their finish out. And then the other 20% was a jujitsu studio. So as you can imagine, fairly wide open spaces, pretty easy to see what's going on. They're ground level, then the 3 floors above it are the residential.
Well, let's talk about the financial due diligence, because you mentioned that from time of finding the deal to closing the deal was about 18 months, and that you were looking to get the deal under contract once it was stabilized. Tell us a little bit more about the financial due diligence.
Yeah, I mean, a big part of that is getting historical financials. We're using that to underwrite as we're going along and tracking lease up on the retail and residential side. For the retail piece, we want to get copies of the leases and estoppels, basically the tenant saying, yes, this lease is true and accurate. And so we can rely upon those projections. On the residential side, you're taking a really hard look at not just the T12 and the rent roll, but also aging reports. Something that's not uncommon, unfortunately, is for the rent roll to have a number of vacant units that are shown with people in them, or potentially, there's just various ways that a halfway experienced property manager can try to slip in basic fraud happening, and generally try to minimize the amount of surprises that you step into as an operator. There's always surprises when you're buying a property, and oftentimes those are not connected to fraud, but you want to make sure that you check as many boxes as you can and get multiple months of data, make sure that that's matching. In our case, it helped that we started tracking this property and getting financials the moment it became available for rent. And so we had a lot of historical data to back it up and make sure that everything was on the up and up, which it was.
Hmm. All right. Well, you mentioned on one of the buildings that there was an issue with one of the retail clients. So how did that play into the closing process?
Yeah, so the retail tenant, one of the things that we had to work on was the lease for the larger tenant, involved them getting a rent credit and not paying rent until their space was operational. And then they have a graduated rent schedule based on the number of students that they enroll. That's not all that uncommon. It's a little bit of a sweetheart deal, but this particular daycare is kind of a higher end daycare with 5 or 6 other locations in the Kansas City metro. So it's an established operator. They're a credit tenant. A really fantastic tenant for this kind of a space. And so the developer did a great job at landing this prospect. But when it came time to negotiating the contract, we have a separate loan. The way that this project is structured, again, 2 different contracts, 2 different loans, though with the same bank. And so we needed to pay debt service, and the tenant isn't moving in until February. We purchased it in November. And so we ended up negotiating with the seller. And they ended up pre-funding essentially 6 months of rent in an escrow. At that point in time, we weren't exactly sure when the finish out was going to be completed. And so they went ahead and escrowed 6 months of rent. And then we get to draw on that rent monthly, to make sure that on our side, we're able to make debt service payments, able to meet our projections. And it also worked out for the seller, because again, he was really focused on that top line purchase price. If he'd been willing to discount the purchase price, we could have done that as well. In fact, we may have preferred that to get in at a better basis. But ultimately, we wanted to make sure that we could stick with our projections as near as possible when you put those into your underwriting. And he wanted to maximize his purchase price, and an escrow made the most sense.
I actually just interviewed somebody else who did a similar thing on a straight multifamily deal. So the escrow wasn't on the retail client, but rather in the community. They wanted the occupancy up to 90% or to stay at 90%. And so for any unit that was continuing to remain vacant for the first 90 days of the hold, there was money in escrow that they could draw against. And I guess the banks love that.
Yeah, I mean, most banks, when you're looking to finance, especially multifamily, 90% is kind of the floor for your most favorable credit spreads. That's a really big deal, especially with the agencies, which is where a lot of multifamily is being sourced these days. And so we've seen that as a seller even. We've had that written into a couple of the contracts that where we've been selling properties here recently, is making sure that there's either an escrow or a per unit charge for every unit that you drop below that 90% threshold. It can be a significant motivator too, depending on how the contract is written, because it usually is a meaningful difference. We're not talking $100,000 or $200,000 in loan proceeds. It can easily, on a $40 million deal, be $1 million in loan proceeds if you're 3 units underneath that 90% threshold. So that's a big risk factor that people try to control for when they're purchasing. We try to control for that when we're purchasing, and we work with people who are trying to control for those factors when they're purchasing from us.
Well, let's move on to the financing. Perfect segue. How did you finance this deal, and what were the terms? Give us a little insight on this.
Yeah, so we went in planning to use a local Kansas City bank for the retail piece. And we were actually originally aiming at agency debt on the multifamily piece. The problem was the purchase price on the multifamily was $8 million. And we needed the loan amount to be $5 million or above to qualify for standard financing. Sometimes you'll hear it referred to as large balance financing. The challenge is if you drop below that $5 million mark, the credit spreads go from, call it 160 basis points to more like 225 basis points to up to 250 basis points. So it can be as much as a 1% swing just based on which program you get slotted into. And we knew we were right on that edge. The advantages of agency execution, as your audience probably knows, is usually lower interest rate. And you usually get a little bit longer IO than you get through regional banks, interest only. But in this case, after underwriting it both ways, we ended up going with a local bank for both pieces. They had really flexible prepayment terms, no prepayment penalty whatsoever on this deal. The interest rate ended up being a little bit higher, more like 6.6%. It was the same across the retail and residential, a year of interest only payments. But again, that no prepayment penalty, and they gave us higher proceeds than we were underwriting to, even on the agency side. And so that's one of the advantages of working with smaller lenders. There was a little bit of recourse associated with that my partner and I absorbed. But the advantage of giving a little bit of recourse, which is a risk factor, and working with a local bank is they tend to be a lot more flexible and less programmatic in their approach. They had done some financing for us on a very similar deal on the retail side, quarter mile away, and really wanted this deal. And so we were able to get something done.
Awesome. And so is there any sort of prepayment penalty or lockout periods should you want to refinance this?
Nope. No lockout, no prepayment penalty whatsoever. So the way rates are going, I'm not sure that we're going to exercise that in the first 6 to 12 months of the deal. But there's going to be a lot of opportunities. And if rates do dip, we're going to be really well positioned to take advantage of that.
Very nice. Very nice. And so did you raise capital for this deal?
We did. Yeah, we raised about $5.5 million for this acquisition.
So tell me how you structured this for your partners then.
Yeah, so generally speaking, we had a couple different classes of shares depending on how much folks brought, but our base capital stack is a 7% preferred return with a 70-30 split. And that could change up to an 85-15 split and a 10% preferred return if you brought, I think it was $500,000 or more. So we're just trying to figure out ways to continue to incentivize folks to invest a little bit more in each deal. But the vast majority of the funds that came in were under that 7%, 70-30 split structure.
And was there any additional like IRR hurdles or anything like that?
On this deal, we projected somewhere between a 13 and 17% IRR range, where we generally guide to a range instead of to a specific figure. Our base case, though, was about a 15% IRR. And so we have a hurdle that changes that from a 70-30 to a 50-50 split if we reach a 15 IRR.
Sure. And what's your anticipated hold time for this deal?
We generally believe 5 years. That's pretty standard across the industry, as we're all going to model off of 5 years. That allows limited partners, potential investors to look deal to deal and kind of compare apples to apples. We have a lot more flexibility than you do in some deals with the way our debt is structured. And there's also multiple pieces here with the retail and the residential. And they probably will get sold to different buyers at the end of the day. Not necessarily, but I would guess they would be. And so we may not dispose of them at the exact same time. So, I'm pretty bullish on real estate in general over the next 60 months. And I think that that's a good approximation, but we always tell our investors, it could be 3 years, it could be 7 years. One of the worst things that can happen in real estate is to be forced to liquidate on the market's time scale or time schedule instead of your own time schedule. And so we give ourselves flexibility in our operating docs and in our conversations with investors to say 5 years is the plan, but there is some wiggle room there, so we can adjust and make sure we get the best outcome for our investors, and not be forced into something, kind of arbitrarily.
Awesome. And what kind of fees did you charge to this deal?
So we charged a 2% acquisition fee, a 2% asset management fee, and then a 50 basis points on the debt fee for the loan signing because there was some recourse. We don't charge fees for signing on loans generally unless they're recourse.
Gotcha. Well, let's talk about, actually, as we wrap up, I have 2 questions for you. What was easy on this deal that quite honestly you thought would be harder? And then what ended up being harder on this deal that you thought would be easier?
That's a good question. Overall, the lending process was just very easy. I have worked with this bank before, so I'm not sure that I could qualify it as a total surprise. But again, another reason to work with local banks. The back and forth is just really almost non-existent. They're very straightforward. They have a good team at this bank that wants to get deals done. They're actively growing. I think that's something to point out is you want to try to find banks that are looking to grow deposits, growing in locations, growing with the number of loans that they're originating. That just made the process so much easier. It was one of the easiest closings that we've had across 20 different transactions on the acquisition side. Harder than I expected. The in-place property management team, which we've transacted with before, we've bought from ownership groups that use this same manager. Just not, it's more of a mom and pop operator. And that led to some significant difficulties while we were under contract, getting some of the more granular reporting. They were giving us kind of their version of T12 and rent roll, but that didn't have all the details that we needed. Getting aging reports, some of those types of things were pretty difficult, and more than you would anticipate. But there's also opportunity. That's why we were buying this, is we believe there's operational upside.
Awesome. Well, Sam, thank you so much for sharing your knowledge and expertise with us here today. If listeners want to learn more about you, how can they do so?
Yeah, go to our website, lifebridgecapital.com. That shares a little bit more about who we are and what we're passionate about at LifeBridge. I'm fairly active on X. So if you want to hop over there, you can just follow me at Sam Rust. I'm trying to be posting about real estate, family, and anything that I find interesting, which tends to be historical in nature.
Awesome. Well, Sam, thank you so much for joining us here today. We look forward to hearing about your future deals.
Thank you, Whitney.